Welcome into the program. This is Financial Focus with the best of the best in financial services as named by the readers of the Lake City Reporter, 9 straight years and running the team from GulfCoast Financial Services with more than 31 years helping North Central Florida proactive savers and investors formulate the financially focused plans, achieving your financial and retirement goals. Ladies and gentlemen, founder and CEO John Kuykendall here with us as always, providing us guidance and insight. And John, it is the time of year where we are thinking about giving and gifting, and perhaps maybe even more than just the $20 in the Christmas card. We should be thinking about giving and gifting on a financial level as well.
Well, that's right, Peter. I think there's a lot of misconception about how much people can give away without incurring taxes. I remember back many years ago when my grandmother had a job and she had retired, and so she thought that she could only give each child $10,000, which was the limit back then. But the thing was her estate wasn't anywhere near the estate tax level, so she could have given whatever she wanted to, and there would have been no penalties, no taxes, no problem. But a lot of people are misconstrued about that. But Peter, we talked recently about giving and about budgeting. And I just want to reemphasize again that we have to budget during this time because we don't want to get carried away and have that credit card debt, which 47% of Americans say is increasing, and they have an outstanding balance. And I know that this year, according to Deloitte, the accounting firm, people are on target to give over $1,600 per person this year, which is the most we've given since 2009 as way of gifts. So, we're charging more, we're spending more, we're being more generous, and that's going to create problems down the road. But also, if we're in the situation where we need to do some estate planning, then we should go ahead and start thinking about how we're going to gift. We talk over and over again about 2025 and the taxes sunsetting in December 31st of 2025. Well, the inheritance tax also sunsets. And right now it's right at, I think, a little over 13 million. We would have to have each 26, 27 million per couple before we would incur inheritance taxes. And there's a lot of talk about that going back to 3,500,000, Peter.
Yeah. So, taking advantage of that now is an opportunity because if you get the funds out of your estate while those levels are higher, you're sort of grandfathered in. Those funds have already been dispersed, right, John?
That's right. And that's the reason we need to think about it. I saw this thing this morning where if we're looking at those estate taxes right now, it's $12,920,000 per individual, but it goes up in 2024. But don't forget, 17 states also have state inheritance taxes. So if you were to die with $10 million in your estate, and you died in Oregon, you wouldn't pay any estate taxes, but you would pay $1,400,000 in state inheritance taxes. Now, in 2026, that goes up to $2,856,000 for that $10 million, or almost 28%, because those tax laws are sunsetting.
So we've got to be proactive with that.
Yeah, we got to be proactive. And if we did what the legislatures are talking about, going with that maximum of $3,500,000, then the inheritance tax would be $4,040,000 on that 10, which would give us a 40% estate tax. So it's very important, Peter. I don't think people understand it. We say that, the estate tax is not we're way under what the estate taxes are, but those estate taxes are changing, and we need to be proactive.
Well, and in addition, John, we expect some growth on our money between now and the future. So we may not be at a level where estate taxes would currently affect and impact us. But if the levels drop and if our wealth grows, we certainly could be in the future. And these are discussions that we probably need to have well in advance and very proactively with our advisor.
Well, that's right, Peter. We're talking about the great wealth transfer because the boomers are getting older. Even though we're living longer, we are passing on. We're going to be passing on more wealth than our fathers passed on because they had pensions. We've got 401ks and IRAs. So we have saved money, hopefully. And the average boomer 65-year-old says it takes over $2 million to retire. So, we're getting really close to that threshold of $3.5 million if we get to that. So I think it's something we all need to think about. We all need to be aware of it. And we need to understand that, while we have limits on how much we can give per individual or per grandchild, those limits really probably won't come into play. And we can do other things to it, including certain ways to tax shelter some of that money.
Yeah. So a couple things that I've heard so far in the program, John, as we are talking about giving and gifting during this holiday season. Of course, we need to be mindful of our budget during this holiday season. But when talking about our total wealth and our legacy, we need to be mindful of giving and gifting limits and opportunities along the way and what we can do proactively lifetime as well, both taking advantage of opportunity, but not giving away too much too early either, because that could then lead us into trouble in a whole different way, right?
Well, that's true. And going back to my grandmother, she didn't have a lot of money and she gave away that $40,000 and ended up later really needing some of that money. But of course, the kids had already spent it. So we don't want it to be that. I think back to the client I talked to one time who had a tremendous amount of credit card debt. And I went to her and I talked and I said, well, why don't we your land's free and clear, your farm. Why don't we put a mortgage on your farm, pay off the credit card debt? We'll be taking from 20% interest down to 6%, and we can get this paid off quicker. And she said, well, I'd love to do that, but I gifted my land to my kids ahead of time. And so I'd have to go talk to them to see if they would let me do that. So we have to remember, Peter, that we don't want to do things to that are going to hurt us later. We have to be active, but we also have to set things up so that we still have control and we can still maneuver if we need to.
Yeah. And of course, pros and cons to consider in every financial decision. But when it comes to the giving and gifting, we want to do it wisely. We want to do it effectively and efficiently, especially for our family, because the way that a lot of Americans are leaving assets, the IRS may end up being one of the largest beneficiaries. We don't want that to happen if we can possibly be proactive and avoid it. We want to do it with forethought and planning. And so, John, there's the annual gift limit. There's the lifetime gift limit. Even if we go over the annual, we can write it off against our lifetime gift exemption and maybe transfer a great deal more wealth ahead of any changes to those estate tax laws and limits, correct?
That's right, Peter. Then there's also we can do certain things with trust and other ways to protect our money. With the Secure Act being what it is and what it's done to confuse our transfer of our money and create more taxes and more burden for our beneficiaries, we certainly need to take advantage. We need to look at all of that, plus the things that we can do to make sure that we're paying the lowest estate taxes and that we're gifting properly and that we're setting it up so that we're not producing a burden on our heirs.
And John, we don't want to forget that like our house and our property is included in that wealth when it transfers. That would be something that was included in how much is passing on that may incur those estate taxes as well. But I think there's another common misconception, John, where people are concerned about that death tax or the estate tax, when in fact a lot of their wealth is still held within tax-deferred IRA or retirement accounts. You mentioned that Secure Act. I think that's an important point, because before we even get to estate taxes, a lot of this wealth that is being transferred in the coming years and decades, the great wealth transfer that we are in the midst of now, a lot of it is still yet to be taxed. Income tax is going to come before estate taxes.
Well, that's right, Peter. I mean, we are sitting there looking at having to pay income tax, ordinary taxes, on the money that we're giving. And so it depends on what tax bracket you're in when we inherit this money. As you know, we've talked about on this show before, under that new Secure Act, we have to take the money out in 10 years. But there are certain other ways that if we're not careful, we're going to end up having to pay taxes on that immediately. So we need to make sure that we have the right beneficiaries and we have it set up the way that it makes the most sense to avoid paying all the taxes at one time. I mean, if you've got a situation where you've got an individual that's making $60,000 a year, and all of a sudden they get $1 million dumped in their lap. Now they've made $1,060,000 that year, and they got to pay taxes on all that. And it not only affects, as we've talked about, the income tax, but the Social Security tax, and also the Medicare Part B taxes, or that monthly premium is charged, is indexed for income. So it just creates a whole bunch of things that we need to think about and be aware of. And to do the best job to do that, we have to do the financially focused income plan, so that we can look at the estate, we can look at the taxes, we can look at how we're passing this on, what the structure is, and then move forward from there with the best, most efficient plan that we can give you.
Well, if you'd like to get that financially focused written retirement plan put together, ladies and gentlemen, you are always welcome and invited to call GulfCoast Financial Services and begin that process, or review and evaluate your current plan. They are a phone call away. They do offer a complimentary review of your current plan, or to analyze your situation and begin to put that plan together for you and with you. Just give them a call, 386-755-9018, 386-755-9018. And John, I think we would be remiss if we did not mention, we've talked a lot in this program about giving and gifting to family members, but this is a time of year where a lot of people are charitably inclined as well, and may make donations to organizations or charities of some type, or even just regular tithing to a church. Those also are obviously a form of gifting and giving, and I think a lot of people are confused about the deductions that they may receive for those. Not many people actually receive a benefit for a tax deduction from those gifts or tithes any longer, with the standard deduction being so high. I mean, not a reason not to do them, but we have to understand the nuances of the tax code here when making those kind of gifts, correct?
Well, that's right. Just because it's a charity and it's a 501c3 doesn't mean you're going to get a tax deduction. With the large deduction that each individual and each couple get, and especially those over 65, you're looking at $27,000, $28,000 standard deduction, and very few people have that much expense that they can write off. And so we have to do what we can do to avoid that. And one of the ways we can do that, Peter, if you're over 70 and a half, as you know, we can give the charity and the church or whatever it is the money directly from our IRAs, have the custodian send the money to them, and it doesn't count as income for us, and we don't have to pay taxes on it. So it's a way to give it out tax-free. And at the same time, if you're doing a minimum distribution, it will lower that minimum distribution by the amount that we're giving. So it just works better for us to do that. And we're doing that now for a lot of our clients. We've done some we've done all year. Some we're doing right now as we're finally wrapping up the last of the minimum distributions for 2023. we are making sure that those contributions are paid. But, you can do that because what we do is we look in October and then we start planning on how much tax each of our clients are going to pay. And then we make recommendations on what we're going to do to help eliminate some of those taxes and get the best write-off.
Yeah, it truly is a win-win-win with that qualified charitable distribution. Satisfies the RMDs. That's one check. The church, the charity, the organization gets the full use of 100% of a tax-free donation. That's check number 2. And then we get to move money out of our IRA, money that we've never paid tax on, and gift it with that full value. It truly is tax-free money. The third check. That is a great strategy. And John, would you say that if somebody is making donations, if they are doing tithing, if they are charitable in any way, that if we have the two side by side, we could gift cash out of our after-tax account, out of our bank account versus out of our IRA after 70 and a half? There's really not a question of which side we should do it from, is there?
No, Peter. I mean, that's the reason we talk it up to our clients. If you're over 70 and a half, you should be doing that because there's no reason not to. Like you said, it's a win-win-win. And there's no reason to be giving your cash dollars that you've already paid taxes on and you're not going to get the deduction for. So we might as well go ahead and get the best bang for our buck, which is to give it out of our deferred money tax-free. And it's great. And like you said, the charity gets 100% of the money. There's no fees, no charges, and nothing that they have to pay. We just have to send it directly to them. The client can't touch it. That's the way the law is written.
Yep. Well, if your advisor has not been discussing that strategy alone with you, it could be an indication you're missing other very valuable opportunities. It is certainly something to explore. If you are charitably inclined, if you are donating, if you are tithing over the age of 70 and a half, this is the way to do it out of those IRA or tax-deferred accounts, ladies and gentlemen. Yeah. Pick up the phone, give a call to GulfCoast Financial Services if you have any questions about that. It's not necessarily something that's difficult to do, but it's something that you don't want to mess up on. Cross every T, dot every I, and they can help you make sure that is all processed accordingly. Give them a call, 386-755-9018, 386-755-9018. John, as we've been talking about all of this, gifting, giving, taxes, all a concern, we also want to make sure that we've got our legal documents in place and our beneficiaries are correct. This is another big part of wealth transfer and giving and gifting, isn't it?
Yes, it is. I mean, we want to make sure that the beneficiaries are set up. The tax laws as they change, or the laws as they change, the Secure Act made some big changes. And if your IRA is still a trust, when the trust inherits the money, they're going to pay the taxes then. So you're going to lose or in other words, that money's going to be taxed at the trust tax rate, not the individual tax rate. So where an individual beneficiary has 10 years to pull that money out and time the taxes, the trust doesn't get that. So there are things that we need to look at. Things change. Legal documents change. If you don't have your will, your power of attorney, your health surrogate form, and your living will, then you're not ready for those final days. And if something happens unexpectedly, it's going to create problems for your heirs and problems for your spouse if she or he is still here. So we need to make sure that it's not, people hate to go to attorneys. I hate to say that, but I guess it's the cost. It's kind of like going to the dentist, Peter, as we talked about earlier. I'm not really looking forward to it, but I got to go. And we need to think of the lawyer like that. Those documents aren't that expensive. I mean, we've got a lawyer here in town we work with. He doesn't charge that much for those forms. Everybody needs to have them. If there's too many horror stories of people running into problems, families running into problems, kids not having food and clothing because their father or their mother didn't fill the forms out that needed to be filled out.
Yeah. Yep. And as we are in the holiday season and maybe spending some time with family, John, another important aspect of this not to be overlooked is that it's not just the money. Yes, we want to efficiently and effectively transfer our legacy and the value of our dollars, but we also want to transfer values. And we should probably have conversations with our family about money. Maybe around the holiday time is a good time, even if it's not too detailed in depth and talking about exact dollar figures, but a conversation about the values that we have with our money is a good place to start.
Well, I think you're right. We tend to shy away from that. I think often of a relative of mine who went to her mother and said, "I'd like to get my inheritance now." The only thing was there wasn't any inheritance.
I'm sure you would.
But Mama didn't want to have to tell her, that they didn't have a lot. They were living pretty poorly, and I'm sure that she would have loved to have given a lot, but she just didn't have it. But we shy away from that, and we should explain to our people what they're getting. I've sat down with my two boys, and they understand what they're each getting, what they're supposed to get. Hopefully I can spend most of it before I go, but if I can't, at least they know what's expected of them, and they can move forward. And hopefully it'll be a smooth transition that won't cause any family drama. I know of story after story of family drama because of things not being handled right. And not being talked about ahead of time, as you said, Peter. But I think we shy away from that,
Yeah. Well, during the holiday season, we think of gifts and giving, John, fancy bows and packages and wrapping paper. But it's, not everybody's goal to leave a great deal of wealth behind. That's not a selfish kind of sentiment. But the reality is, if we have planned effectively to provide for our own lasting financial confidence, the likelihood that there will be something left behind is pretty high. And so we need to also have proactive conversations about how to make the most of that. And that's what the planning process there at GulfCoast Financial Services is really all about.
You bet. That's what we're here for, and that's what we want to do, is make sure that if you want that plan, we'll put it together for you. We'll give you our best guess as to what you need to do to take care of your documents, and we will, help you seek out what you need and make sure that you're taken care of.
Yeah, and you shared a great article in preparation for the program about the great wealth transfer. In the past 10 years, 17% of adults have received an inheritance, and in the next 10 years, 15% of adults anticipate in receiving some kind of inheritance. There is a lot of wealth. On average, adults who expect to receive an inheritance, they are anticipating about $738,000, $738,000. A lot of wealth that will change hands generationally in the coming years. John, we want to do the best thing with that and for that as possible. That's the planning process there at GulfCoast Financial Services. So definitely worth the time and to have that conversation, ladies and gentlemen. Give John Kuykendall and his team there a call, 386-755-9018, 386-755-9018. Or you can skip the phone, always available online, GulfCoastFinancial.net. If you'd like to be in touch there, just hit the connect with us button. Again, GulfCoastFinancial.net. John, always a pleasure, and we appreciate the conversation, important conversation, as we are in the holiday season.
Well, that's right, Peter. Appreciate you having me this week, and I hope you have a happy holiday season.
Absolutely. You and the entire team there at GulfCoast Financial Services as well.
Thank you. You too. Hey, if you'd like a copy of our new book, Quitting is for Winners, but Retirement's Not for Wimps, I encourage you to click the link below and get your copy today. Hey, we like it when you listen to the show, but we like it better when you like, share, subscribe, or feel free to leave a comment.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.